Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. We are diving deep into a market event that has, well, it's basically redefined volatility and challenged all the old assumptions about safe haven assets.
You're talking about the historic surge in precious metals.
Absolutely. This isn't just a bull run. We are witnessing a genuinely parabolic move that has completely reset investor expectations.
The data points are pretty staggering.
They really are. Gold spot prices just hit an unprecedented $4,639 an ounce, a new all-time record.
And silver, too. Often the laggard, but it just crossed $90 an ounce for the first time ever.
Right. And according to some recent analysis, these are the kinds of numbers that demand a complete, portfolio review.
What's really fascinating about this moment is that market participants are calling this a true regime change.
Not just a temporary spike.
Exactly, not just a temporary fear-driven spike. The thinking is that the structural foundation of this rally is just far more robust than what we've seen in past surges.
So what's the core difference this time?
It's the nature of the demand. We're seeing this persistent structural buying, especially from sovereign entities.
Central banks.
Central banks all over the world are building reserves, and China's central bank, in particular, continues to be this massive, dependable buyer. It signals a real long-term preference.
So that structural demand is the anchor, but what's really launched the price into the stratosphere right now?
That's the key question.
Our mission for this deep dive is to unpack the four major overlapping drivers. We're talking geopolitics, interest rates, policy trust, and trade policy. They're all converging to create this intense environment.
A perfect storm, really.
Okay, let's unpack this and maybe start with the foundational economics, the interest rate dynamic.
Sure. When we look at precious metals, their appeal is always measured against the return you can get on safe, interest-bearing assets, think U.S. bonds, or even just cash.
The opportunity cost.
Precisely. The basic principle is, if the return on holding cash falls, the opportunity cost of holding a non-yielding asset like gold goes down. That makes gold instantly more competitive.
We get the relationship, but what was the immediate trigger? What caused this surge to happen right now?
The most recent catalyst was the release of the U.S. CPI inflation data on January 14th.
And the numbers came in weaker than expected.
Weaker than market expectations, yeah.
Yeah.
It suggested that inflation was maybe cooling on faster than anyone anticipated.
Okay, hold on. If inflation is easing, why would that ignite a massive rush into gold? That feels a little counterintuitive.
It's all about the immediate market reaction to Fed policy. When inflation risks seem to be going down, it clears the path for the Federal Reserve to cut rates.
So investors started pricing that in immediately.
Aggressively. They priced in stronger bets for significant Fed rate cuts this year. They're betting on a start as early as June, and even modeling the potential for 2 full rate cuts before the end of the year.
So the market isn't even waiting for the Fed to act. They're just adjusting their positions based on the expectation of what's coming.
That's how it works.
Yeah.
And that expectation immediately lowers the real interest rate.
Can you break that down for us, the real rate?
Of course. The real rate is just your nominal return minus inflation. So when the market prices in lower future nominal rates, the perceived return on something like a T-bill just drops.
So if my T-bill goes from earning, say, a 3% real return to a 1% real return.
Yeah, that 2% difference is immediately absorbed by gold as a lower opportunity cost. It's like the market suddenly discounted the price you have to pay to hold a safe asset that doesn't pay you an income.
And that resetting of expectations provided the initial powerful tailwind for this rally.
That's what got the ball rolling.
Okay, that takes us smoothly from the predictable economic forecasts into the realm of unpredictable risk. The rally started with rates, but here's where it gets really interesting.
Right.
Because the current price suggests the market is pricing in something far more profound than just a lower cost of holding gold, it feels like it's about systemic confidence.
Absolutely. We have 2 parallel systemic risks that are hitting at the same time. First, you've got geopolitical risk.
The classic fear trade.
The classic fear trade. Global market analysis has been citing rising tensions, especially linked to Iran-related disputes, as constantly raising the overall risk premium across all financial assets.
So when instability is in the headlines, funds just fly to quality.
It's standard. Funds move toward tangible, universally accepted safe havens. But that's not the whole story.
No, and this is the real game changer. The element that really separates this rally is the institutional trust shock.
This is the big one.
Our sources highlighted a detail that sent shivers through the financial community, a report about a U.S. Department of Justice investigation or a potential charge involving Fed Chair Powell.
And this is an enormous concern. You could forget the details of the investigation for a moment. The market implication is immediate and, frankly, existential.
What's the fear there?
It instantly raises the fear that monetary policy could be exposed to political pressure. The entire strength of the Federal Reserve, the reason global markets trust the dollar system, is its perceived independence.
It's independence from political cycles.
If that independence is compromised, even by speculation or a rumor, the confidence in the entire U.S. financial architecture starts to waver.
So we're moving way beyond simple economic hedging now. We're not just worried about inflation, we're worried about the stability of the institution that manages the economy.
Precisely. This is why we say this rally is deeper than a standard fear purchase. It's a direct hit on the Fed's perceived independence. We are witnessing a repricing of the policy confidence premium.
A policy confidence premium.
Think of it this way. The price of gold is now reflecting a systemic discount, a discount being applied to the reliability of our major financial institutions. Gold isn't just a hedge against a downturn, it's a defense against a breakdown in policy integrity.
That is a staggering implication. Investors are paying this much to insulate themselves from political influence on the economy.
That's the story the price is telling.
Now, let's add another layer of uncertainty. Trade policy. This one hits industrial metals particularly hard.
Right. This brings us to a really specific area of governmental uncertainty that creates massive volatility. The potential for Section 232 tariffs.
Section 232. That's the measure allowing the president to impose trade restrictions on specific metals.
Correct. Things like silver, platinum group metals, even tin. It can be used if they're deemed a threat to national security.
And we've seen this used before. It often leads to these really unpredictable market shifts. What happens if these tariffs are put on a metal like silver?
It creates what investment analysts call a major binary risk.
Binary risk, meaning one of two outcomes.
A risk with two highly contracting outcomes based on a single yes or no policy decision. If the tariffs are imposed, supply chains are instantly disrupted. Prices could surge dramatically because you have constrained supply here in the U.S. market.
So that immediately expands the role of these metals.
It completely changes their function. They stop being just an inflation hedge, and they become a powerful supply chain hedge or a trade policy hedge. You're buying protection against the soaring cost of materials due to a sudden policy change.
That distinction really helps us contrast gold and silver in this new high-stakes environment. Gold remains the pure defensive play.
Gold is clearly reaffirmed as the true hedge. It's the asset you hold against that triple threat: policy reliability shocks, geopolitics, and falling real rates. It's the stable store of value when the system itself feels wobbly.
But silver is behaving much more dramatically. It's the one that shot up to $90. Why is it so much more leveraged?
Because silver functions as a leveraged, or you could say a high beta hedge. Its beta, its sensitivity to market moves, is higher because it has a dual personality.
Financial and industrial.
Exactly. Gold is purely financial. Silver is financial and industrial. It's used heavily in manufacturing, everything from electronics to solar panels. So when you combine that extreme financial stress with robust industrial demand and the threat of a trade tariff,
The price movement is just amplified.
dramatically, it's an explosive combination.
And high beta means bigger rewards, but what are the practical consequences for someone holding silver right now?
It demands caution. Because of its dual nature and its high volatility, the data warns that silver may rise faster, sure, but investors must be fully prepared for it to experience much deeper and more severe corrections than gold.
The moment one of those drivers eases off.
Right. If industrial demand slows or financial anxiety calms down, silver can fall hard and fast. It's the higher risk, higher reward way to play this regime change.
And before we pivot to strategy, a quick note on the digital gold argument. Bitcoin is still out there, but it hasn't really acted like a systemic hedge here.
That's right. Despite being called an alternative store of value, Bitcoin can still behave like a traditional risk asset during these broad-based systemic crises, especially if liquidity dries up. Physical gold just retains that non-correlated hedge status.
So that's why gold remains the critical hedge against policy failure.
It does.
So we've established the four drivers: rate cuts, geopolitics, institutional trust, and tariffs. Now, for the crucial question for anyone listening and reviewing their portfolio, given that prices are at historic highs, How should you approach an investment strategy?
This is key. Given the intense market psychology right now, the feeling that prices are already very elevated, the strategic advice pivots decisively away from aggressive lump sum buying.
Because you risk buying the absolute top.
You absolutely do. The expert approach right now favors phased accumulation, or rebalancing. It's about regularized weighting.
Yeah.
You commit to buying consistently over time, regardless of short-term price moves, to maintain your target defensive allocation.
It takes the emotion out of it.
It removes the emotional element of trying to time the peak, and it averages out your purchase cost over time. It's a much more disciplined approach.
And speaking of risk, how stable are these high prices? Are people getting nervous?
There's definitely heightened volatility. Fund flow data suggests significant position instability, even among the bulls.
Really?
Yeah. While funds saw steady inflows through late 2025, we actually registered a temporary net outflow in early January of this year, right as the price was spiking to its records.
So even as the price was going parabolic, some people were selling.
That unwinding, even briefly, it suggests nervousness, a lack of conviction. It signals that this heightened volatility is likely to continue as traders adjust these very expensive positions.
Okay, let's turn to mining stocks. Companies like Barrick and Newmont are obviously direct beneficiaries of these prices. How do they fit into a portfolio strategy here?
Mining stocks are certainly sources of additional profit in an environment like this. They offer powerful operational leverage.
Meaning if the price of gold doubles, their profits more than double.
Exactly. If the price of gold doubles, but their cost to dig it out of the ground stays relatively fixed, their profit margins just explode. They are an amplifier of the commodity cycle.
But, and this is the crucial distinction, they are not the same as holding the metal.
Absolutely not. They are not hedges in the same way physical bullion is. They introduce a whole set of separate business risks that actually increase their overall volatility compared to the metal.
You're exposed to things like production costs, labor issues.
National risks, unexpected tax hikes, or royalty increases from foreign governments or project delays. If you hold Barrick, you're taking on business risk and country risk in addition to the commodity price risk. They should be viewed as an aggressive growth play, not a core defensive shield.
A very important distinction.
To kind of synthesize this whole historic moment, this rally to $4,600 gold and $90 silver is not a standard economic blip. It is driven by this powerful confluence of four deeply connected structural shifts.
Geopolitical tension, the debate around Fed independence, rate cut expectations, and the threat of tariffs.
Right. And the most important takeaway is that the market is reflecting a deep structural defense demand against systemic instability. Investors are using precious metals to hedge against the intangible, the reliability of our institutions, and the integrity of trade flow.
That is the perfect summary. And here is a final provocative thought for you to chew on this week. Considering that Section 232 uncertainty we discussed, that potent binary risk of trade restrictions, how might increased trade volatility influence other critical industrial commodities in your portfolio?
Things beyond just gold and silver.
Exactly. Think deeply about copper or nickel or rare earths. That supply chain risk premium isn't isolated to precious metals. It could shift the entire material cost base of the global economy.
A lot to think about.
Thank you for joining us for this deep dive. We hope this gave you the clarity you need to navigate these turbulent markets. Don't forget to subscribe and hit that like button.